So this video is all about 401k retirement accounts, and 401ks are the most common type of retirement plan. So let's take a look at this graph charting the number of active American workers involved in retirement plans. This is from a good source from the Congressional Research Service done in 2020. And on this y-axis here, we're going to chart the number of workers in millions here. So we're going to start with this blue line, which is going to be tracking the number of workers on pension plans. If we start in 1975, it's going to be a little less than 30 million. And by 2020, it's going to be about 17 or 18 million American workers on pensions. And now let's track 401k accounts. And this is going to be the opposite trend. So the number of workers on 401k starts around 17 or 18 million in 1975. And now it's going to be over 80 million today. So again, the key to understand is most employers today offer 401k accounts over pensions. The real question is why? And the answer, in one word, it's cheaper. And this is because whereas pension plans require the employer to make monthly contributions to an employee for life, 401k accounts allow employers minimal investment and therefore more free-flowing funds in the future. So that is why they do more 401ks now. But the question is, how do 401k plans work for you? And so the best way to think about 401ks is in three major steps. And so the first is that you're going to contribute an amount each month from your paycheck to the 401k account. Then once you do that, the second thing is that your employer matches whatever you contribute up to 6% of your paycheck each month. And then third is your money is going to be put into an investment account that gains hopefully an average from 4 to 8% yearly returns each year. So those are the basic three steps of a 401k. And now let's go look at this visually. So let's say this is you, and this is going to be your employer, and over here is going to be your 401k account. So every year you work there, you're going to contribute some amount, and then the employer will match that amount. And then again, you work some more, they're going to match, keep working, keep contributing, they keep matching, keep working, they keep matching. And then this account is going to keep building up years over years over years as you keep contributing, and they keep matching up to 6% each year. And then by the end, when you get to retirement, you have this big old 401k account built up. But there is also this other caveat that the idea is that the account will actually be building compound interest the entire time alongside you and the company's reoccurring investments. So what you see here visually, that's just the amount that you've contributed. But if we add this over here, the compound interest that the account has gained over the years, that's going to be an extra bunch of money. And actually, over a long period of time, the interest built up in the account will actually be more than the contributions made. So your account is going to be quite large over a period of many years. So all that's good information, good and well, but let's now go over the two types of 401ks. And there's two main types. There's traditional 401ks, and then there is Roth 401ks. And the best way to think about these is that traditional 401ks, you're going to pay less now, and then Roth 401ks, you're going to get more later. So there's two trade-offs there. So let's look at these in a little more detail. So in a traditional 401k, when you contribute to that each month, it is going to decrease your taxable income. Because when you contribute to a traditional 401k, you can deduct the amount you contributed from your taxes. So it actually decreases your taxable income for the year. But the caveat to that is that when you actually withdraw these in retirement, your withdrawals are going to be taxed in retirement. So you're eventually going to have to pay those taxes on it. A Roth is different. In a Roth, the taxes are going to be taken out immediately. So you're going to pay taxes on that just as normal. But the good part about Roths is that your withdrawals are not taxed, so you don't have to pay taxes on those later. AKA, that means there's no taxes in retirement. So traditional 401k, think about you're going to be taxed when you're old. Roth 401k, you're going to be taxed when you're young. So it's kind of a trade-off, whatever works best for you or you like better. So let's look at a specific example of both these. We're going to start with looking at traditional 401k. So let's say you got all that compound interest accrued combined with your contributions. We're just going to throw that into one thing and say that's your entire 401k. And over here on the right is going to be a retired you. So retired you, you're going to want to withdraw money from your 401k to live, spend, do whatever with. So let's say when you withdraw that in a traditional 401k, that withdrawal is going to get taxed. So if you think you're withdrawing $80,000, you might actually only get to keep $60,000 of it, which is going to make you quite sad. However, if we look at a Roth 401k, so let's look at the difference here. So the difference is that a Roth 401k, because it's taxed earlier, it's actually going to be less overall in the account. So the traditional will have more money in the account. However, when you withdraw from a Roth, that money, that withdrawal actually is not taxed. So you get to keep all of that in retirement, and that's going to make you happy. So which one is a better choice? It really depends on the person, and it really depends on whether you'd rather be taxed when you're old or taxed when you're young. So next video, we're going to go over actual math on these 401ks, and just a quick reminder to always take it easy.